Welcome back to the channel, investors. Today, we diving deep into a topic that can make or break your after-tax investment returns. Capital gains tax. We're going to demystify the crucial difference between long-term and short-term capital gains in the US, and why understanding this difference is the key to smart, tax-efficient investing. This isn't just theory, this is money in your pocket. So hit that like button, subscribe if you haven't already, and let's get into the world of investment taxes. First things first, what is a capital gain? Simply put, a capital gain is the profit you make when you sell a capital asset for more than you bought it for. A capital asset is almost anything you own for investment, like stocks, bonds, real estate, and even collectibles. The key phrase here is, when you sell it. Until you sell an asset, its appreciation is just an unrealized gain. The tax event only happens when you realize that gain by selling. Now, the opposite of this is a capital loss, which occurs when you sell an asset for less than its purchase price. This is important because capital losses can be used to offset your capital gains, a key tax-saving strategy we'll discuss later. But the most critical factor determining your tax rate is the holding period. This brings us to the main event, short-term versus long-term. The IRS draws a very clear line in the sand, and that line is 1 year. A short-term capital gain is the profit from selling an asset you've owned for 1 year or less. A long-term capital gain is the profit from selling an asset you've owned for more than 1 year. That single extra day of holding can dramatically change your tax bill. And I mean dramatically. Why did the government create this distinction? To encourage long-term investing. The reward for being patient is a lower tax rate. Let's look at those rates. Here is the first big shocker for many new investors. Short-term capital gains are taxed as ordinary income. This means your profit is just added to your salary and taxed according to the standard federal income tax brackets, which can go all the way up to 37%. That is a massive chunk of your profit gone. This is why active, short-term trading is often a less tax-efficient way to invest. Now for the good news. Long-term capital gains get special, lower tax rates. For most investors, there are just 3 tiers, 0%, 15%, or 20%. The rate you pay depends on your total taxable income. For 2025, if you're a single filer and your total taxable income is below about $48,000, you pay 0% in federal tax on those gains. You keep 100% of your profit. Even in the middle range, the 15% rate is likely much lower than your ordinary income tax bracket. If your ordinary bracket is 24%, you're saving 9% instantly just by holding your asset for 1 day over a year. The 20% rate is for the highest earners, but even then, it's a huge saving compared to the top 37% ordinary income rate. Before we get to strategies, a quick note for higher income investors. You might be subject to the net investment income tax, or NIIT. This is an additional 3.8% tax on your capital gains if your income is above certain thresholds, roughly $200,000 for single filers. Also, some assets have special rules. Long-term gains on collectibles like art are taxed at a maximum of 28%, and a portion of gains on depreciated real estate can be taxed at 25%. So, how do you use this knowledge to your advantage? Here are 3 powerful strategies. First, mind the calendar. Before you hit sell on an investment, check the purchase date. If you're close to the 1-year mark, just wait. Holding for a few extra days to cross that threshold can instantly slash your tax rate. It takes discipline, but the reward is substantial. Second, use tax loss harvesting. Capital losses are your friends. This is the strategy of intentionally selling investments that are down to offset any capital gains you've realized. If your total losses exceed your gains, you can even deduct up to $3,000 of that net loss against your ordinary income. Just be mindful of the wash sale rule, which prevents you from claiming a loss if you buy a similar security within 30 days. And finally, strategy 3. Utilize tax-advantaged accounts. The best way to avoid capital gains tax? Invest where they don't apply. Investments in a 401k or IRA grow without you paying capital gains tax every time you sell. With a Roth IRA, you contribute after-tax money and your investments grow completely tax-free. You pay absolutely no taxes in retirement. Always try to max out these accounts first. To recap, the holding period is king. Sell in a year or less, and you'll likely pay a high tax rate. Hold for more than a year, and you get a much lower rate. Be patient, watch the calendar, and use tax loss harvesting to manage your bill. This isn't just tax knowledge. It's a foundational principle of smart investing. A quick but very important note: I am not a financial advisor or CPA. This video is for educational purposes only. Tax laws are complex and change, so always consult with a qualified tax professional before making any decisions. If you found this breakdown helpful, please smash that like button, share this video, and let me know in the comments what other topics you want me to cover next. Thank you for watching, and I'll see you in the next video. Happy investing!